Welcome to Nasdaq TradeTalks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss the reversal and volatility measures despite a number of key events on the horizon. It is great to see both Steves, as always. Steve Wyett, we had the inauguration on Monday, and I don't recall participating or watching one when the market was closed at the same time.
I'm with you, Jill. I've just gone back and done some quick reviews. I don't remember it happening that way. And not just that, Jill, this is an inauguration day that could potentially be way more active than anything we've seen in the past. And so this idea, of any number of executive orders that could be coming down that could be pretty impactful on a number of areas, as we just think about the potential policy changes that we're looking, and we're describing this as a high change environment. That's what we're going into. So to see volatility down, when you think about a high change environment, it just kind of raises your anxiety level. That's not what we're seeing necessarily in the VIX, but man, a pretty big day where the markets are closed, which means Tuesday could be really interesting.
Yeah, it certainly could. And definitely it's going to be must-watch TV, especially if you're trying to figure out who's in the audience and who's not. Steve Sosnick, it's interesting, and we've spoken about this before. The first couple of years Trump was in office with the 1.0 administration, the market didn't move many handles day to day. So it makes you wonder if it's going to follow that same sort of pattern, or if the environment has just changed so drastically since then.
It's interesting because, I think for the first one, I was certainly among the people saying, he's sort of volatility personified, and he wasn't during the first, at least during the first part of the first administration. The market then was, enamored with the idea of tax cuts, understandably so. And so I think they were, and he really, despite some of, despite sort of, the idea that he personally can be unpredictable, from a market point of view, he pretty much, towed the line economically in a way that the markets liked. Now, I think to Steve's point, I read this headline just a few seconds ago. They called it a blizzard of executive orders that could come down the pipe. And so, we don't really know what's happening here. Maybe it's not much, but you have to think that the market's going to have to digest a lot of news. It does have an off day to do it. Remember, Martin Luther King Day is also a relatively new holiday. So, when you think about an event that occurs every 4 years on a holiday that's probably 25 years old or something like that, it's understandable why none of us can remember a market closure on that day. But I think it's fascinating that we flipped from, at less than a week ago, earlier this week, VIX had a 22 handle, and right now it's got a 15 handle. That's a big change in sentiment. My opinion, a measure like VIX is not a fear gauge. It plays one on TV. I've said that enough times, but it does tell you about markets' anticipation for volatility and the market's demand for hedging protection. And it's telling you that they're not expecting much volatility and not much hedging protection. Yet in the 30 days that these volatility measures encompass, you have a very consequential earnings season. You have an inauguration, as we just discussed. And oh, by the way, there's a Fed meeting on the 29th, which, while the Fed's not expected to change rates, they're going to have to tell us something about what they have in mind for rate cuts. And you could see how sensitive we've been in just the last 5 trading days to any changes about the perceptions regarding rate cuts over the coming year.
Yeah, and Steve Wyett, if history serves as a guide with Trump 1.0, he is very clear about benching his performance to what the economy is doing, what the market is doing. Now we're hearing about, global leadership as it relates to maintaining our position in capital markets and technology, innovation, digital assets. He is very clear and measures himself against performance. And I think there's a lot of hopium built into that. And, I think not sure if it's all built in at this point, but it's going to be interesting to see how the administration handles, some of these projections.
And that's a really good point, Jill, because not every one of the policy changes that incoming President Trump has been looking at is necessarily good for the capital markets. When you start talking about tariffs, and there's a lot of misunderstanding there, and candidly, we're we're kind of thinking tariffs are not going to be nearly as big of an event. Although when I'm giving presentations and speaking to the public, I get more questions on tariffs than anything. The bigger policy issue that we're kind of that we think the implementation is going to be really important is around immigration and what that means to the job market, the workforce, where unemployment's still at 4.1%. This kind of plays into this reduction in volatility that we saw this week. I think it shows how sensitive the market has been to interest rates here recently. It looked like the 10-year note was just marching inexorably towards 5%. We got a couple of soft inflation numbers. Now, all of a sudden, that's backed off a little bit. Now we've got a Fed back to easing again in potentially March or June, and the markets feel a lot better about that. But man, there's, to your point, President Trump understands all this. This is why energy prices are so important to him. He wants to keep energy prices low. That's how he's going to try and control inflation from that standpoint, while some of this other stuff might take a little while to work through. But just from an economic standpoint, as rates have moved up, if you do a decomposition of what that is, some of it is we have seen inflation expectations move up a little bit. But Steve, to your point about equity volatility being a little bit subdued, term premiums in the bond market do continue to move a little bit higher, which for a longer term measure of just how much additional return investors are demanding to go to invest for longer periods of time. That's a measure that investors are a little bit more concerned about the bond market longer term than they have been.
Yeah, and Steve Sosnick, expand on that a bit more. Why this is such a powerful message that the bond market is signaling. What does that mean on a higher level?
Well, ultimately, it all does come down to interest rates. I mean, we can, every financial model that you can have has some, has an input of risk-free rate. And so let's just take a basically discounted cash flow model. You're discounting your future cash flows by the risk-free rate over the appropriate period of time. And if that rate goes up, the present value of your cash flows go down. Now, stock market doesn't work that way on a day-to-day basis, but that's from a long-term fundamentals point of view. But I think and one of my other little truisms is, if it's very hard to price safe assets, it's even harder to price risky assets. So when you've had a period where the very short end of the curve has had a lot of volatility, of course, the longer end of the curve is going to have some volatility. And of course, that's going to spill into the stock market. I did say, in a TV appearance on Monday that, I felt that the bond market had gotten quite a bit stretched. And I was thinking that, after the initial wave of executive orders, we would probably have the inverse of a buy the rumor, sell the news type of event. I didn't realize it was going to happen on Wednesday, though. I mean, because it happened very quickly. But so you did have that sentiment. And I think, to Steve's point, is people are a little afraid about inflation, which is why you see the yield curve steepen, why the term premium has gone up. And a lot of the rise in rates has come on the real interest rate side, because, inflation hasn't been moving that much. So real interest rates is the amount of extra return that fixed income investors demand. And so that's telling you they're a bit more nervous, less nervous than they were 3 days ago. But definitely there is a bit, they're not exactly thrilled with what might come down the pipe. They're pricing in definitely a bit more risk than we are.
Steve Wyett, I want to go back to the conversations you're having around tariffs and tie this into earnings for a moment. So we know we're getting reports on fourth quarter, year end, in this first quarter. And of course, the market is anticipating full year guidance and so forth. And I feel like companies somewhat get a mulligan, if I'm using the right golf terminology, because they know, looking at those projections from Q1 to Q4 is different than Q3 to Q4 when you have a little bit more insight. And perhaps the market is priced in. We know the uncertainty of being able to make those operational plans until there's more clarity on the tariffs. So I wonder how discerning investors might be if projections in the first quarter regarding first year guidance are not as clear as they would like to hear.
Yeah, it's a great point. I think analyst estimates for earnings in 2025 continue to move up just a little bit, but this is where the company can come out and say, they're kind of, to your point, they're kind of given a free pass to say, hey, let's be a little bit cautious here. Let's talk about the unknowns, what tariffs may or may not do. Again, we think this is more of a negotiating tool. And when you get down to it, if you go back to, and by the way, you know how you make a negotiating tool effective? You're willing to do it. And this is where the advantage of having Trump 1.0, where he did put those tariffs in. So now as he uses some of this rhetoric, it can have a bigger impact and in fact lessen the chance that you've actually got to take the action on the back end. But I look, it's fair for companies to consider what the changes in the policies might mean to them, while at the same time, if I just look inward at our own institution, and we're going to report earnings after the close today, but I can tell you, based on what I know about our plans moving forward, whatever is happening on the outside, we're still expected to grow as we move forward. So I think it does provide some cover for companies, but in the end, and this is the net, and maybe Steve, this is where I get your take on this as well. The other reason that we're worried about interest rates is that valuations are pretty high. It's not like there's a lot of room for error. And so, Jill, to your point, as earnings come in the fourth quarter and we start thinking about 2025, if we were priced at a lower multiple, interest rates and that stuff might not have quite as big of an impact, but stocks are not cheap by any evaluation metric as we enter 2025. So we're more optimistic than pessimistic,
Right.
but that doesn't mean it's a riskless environment for us as we move forward.
Right. I mean, the market's always going to climb some wall of worry at the end of the
Sure.
day. But Steve Sosnick, and we spoke about this in your December segment last month, it's all about execution at the end of the day. So you can have try and put as much conjecture as you want within your thesis or how you're thinking about your investments, but perhaps maybe you keep some powder dry or you keep things as is, because trading on headlines perhaps for a trader might make sense, but longer term investors and so forth, we're still waiting on the execution of this. It's hard to discern what it's going to look like from day to day or month to month or quarter to quarter.
I had a good refreshing perspective because I did something just for a local charity, just sort of a market talk event with a friend of mine who's a financial consultant, and his time horizon is retirement. My time horizon, particularly when I was an options market maker, was like 5 minutes from now.
Right.
And so, I've mentioned to the group that I'm a sprinter and he's coaching you to run a marathon, and retirement is a marathon, and his he didn't get as caught up in the day to day. And so, I do have to take that perspective. And to Steve's point, valuations are very high. There's no disputing that. But valuations are a very poor timing tool. But what it does tell you, to both of your points, is that I like the idea that we might get a little bit of a mulligan because of the uncertain, political environment. But when you have a situation where S&P earnings are widely believed to be, 13 to 15% for the coming year, that's a pretty high bar. And people say, oh, that's a good reason why the market's going to rally further. It might be, but I'm going to argue that that's priced in. And so if you don't execute that, that's a really big risk. And so you might not get a lot of guidance in one way or the other now because of the uncertainty. It's going to be very difficult for companies to comment on it. But that, I think, is sort of an existential risk going forward, because these companies, so many companies are priced to perfection. And by the way, from an NDX point of view, from a Nasdaq 100 point of view, those expectations are even higher because those companies have been doing most of the heavy lifting for the S&P 500, and of course they're more heavily weighted as a percentage in the Nasdaq 100. Doesn't mean that you need to head for the hills, but it does tell me, as someone who's always concerned about managing risk and managing volatility, that you have to at least be cognizant of this as we go into earnings season.
Yeah, and Steve Wyett, let's wrap with this. As you think of, I'm sure you work with, a lot of longer term investors, and I don't want to use hyperbole like, generational opportunities, but if you stayed in the 2020 lows and then again in 2022, those returns, look, it happened within 5 years, are typically generational for those outsized returns. If you sold out and were afraid to get back in, sometimes it makes sense to, live through these pockets of volatility.
Now, Jill, in my career, I'll go back to the crash of 1987, the internet bubble, the financial crisis, the pandemic, and I'm not asking for any more generational buying opportunities. Don't get me wrong, but this is where we can talk about the short-term gyrations of the market, but gravity in the stock market is higher. If you think about where we're going from an economic standpoint, I can build a pretty bullish case with what artificial intelligence, looking at electricity demand, the investable universe of what could work over the next few years and how our economy could change. And by the way, the U.S. is the leader in this. And so this is another, it's just never forget we live in the greatest country in the world, and we've got the best opportunities for success here. And while I'm like Steve, as a fiduciary, we're always managing risk, and you've got to be aware of that. But man, there's a lot of good reasons to be excited about the future. And if you just nail me down, I'm going to tell you, I think the best is yet to come. So we've got some real issues that we've got to deal with. Not happy about our fiscal position and how we're doing some of that stuff. But man, there's some real opportunities that we're looking at that could be generational. And if you think about a productivity boom that kind of goes back to some of these generational changes in productivity.
All right.
We're optimistic, Jill. We're excited about the future.
All right. And so are we. We'll leave it on a positive note. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.